What's going on, guys? Welcome back to the channel. My name is Anfernee, and in this video I want to talk about how you can get rich in the laziest way possible. Now, this video doesn't have any tricks and gimmicks in it, but it goes over the most effective and proven most successful way to build wealth so that you don't have to constantly stress over your stock portfolio at night. So if you think you're going to find any kind of value in this video, then tap that like button for your boy, and also hit the subscribe button if you want to see more content like this. And as a treat for you clicking onto this video, if you go down into the description and sign up to the public app, they will give you a free stock just for signing up. You don't have to put a penny of your own money into the app. Just press a couple buttons on your phone and get that free stock. And the laziest way and most effective way that you can get rich is called dollar cost averaging. And dollar cost averaging is a method of investing where you invest the same amount of money in the same securities, whether the stock market is up 1,000% or whether the stock market is down 1,000%. The dollar cost average approach cuts out all of the technical analysis that is needed in the stock market. It cuts out many of the headaches and the worries about what your portfolio is doing, and it only focuses on consistent contributions, because historically and statistically, consistent contributions to the stock market wins out 9 times out of 10 when compared to someone who's trying to time the market. And in contrast, someone who's trying to time the market does what all of the gurus say you have to do in order to make money. They try to buy stocks when the stock market is low, and they try to sell when the stock market is at its peak. However, as many financial advisors and many fund managers have tried, it is almost impossible to predict the valleys and the peaks of the stock market. And while the people that are trying to time the stock market are stressing out trying to know exactly when to sell and exactly when to buy more of their security in order for their portfolio to be profitable, the person who is dollar cost averaging is sleeping well at night, because they know that historically the stock market tends to go up over time, and as long as they continue contributing money, compound interest will continue to work in their favor, and they will get wealthier over time simply by putting money into it. If you can put money into a savings account, then you can dollar cost average into the stock market. But now I want to give you a quick example of how this works and what it looks like in a hypothetical scenario. So let's say you are a middle class wage earner who has about $100 extra every single month that they can invest. What most people who try to time the market and not dollar cost average do is they try to wait for a dip in the stock market in order to put all of their money in all at once. So if they have $100 to invest every month, they probably will save that money in month 1, save in month 2, save in month 3, and then in month 4 or 5 put all the $400 or $500 all at once into the stock market, thinking that it hit the bottom. And the risk of trying to time the market is that they may miss all of the gains in the first 4 or 5 months, while also not timing the market correctly and missing the bottom as well. So in a dollar cost average scenario, if you had $100 to invest every single month, you would buy $100 worth of whatever asset you wanted to buy, no matter what the price was. If in month 1 it was up 10%, you would buy $100 worth. If in month 2 it went up another 25%, you would still put $100 more in. But if in month 3 it dropped by 55%, you would still put $100 worth of your money into it. So in this scenario, you're not necessarily worried about how many stocks you can buy, but you're putting the same amount of money in. And also at the same time, with the dollar cost averaging approach, in the month that the asset you purchase falls, you will actually be getting more for your money than if the price had already gone up a lot. So in the month, as I said, it had gone up 40 or 50%. In the next month, if it falls by half in this hypothetical scenario, you will be able to buy 1.5 to 2 times as many stocks as you would have if this situation did occur. And because you should have a long investment timeline, this cycle will continue over the years as you continue to invest. But now let's talk about the rewards of dollar cost averaging. And as I talked about earlier, not only are the rewards that you actually get a more consistent and a better return in comparison to someone trying to time the stock market, but you also get the reward of not being devastated when your portfolio loses value or being overly joyed when your portfolio increases in value. When you are dollar cost averaging, the biggest reward that you should have is knowing that your portfolio is constantly working for you while you sleep, while you work, while you're doing everything else but worried about your portfolio. Your portfolio is continuing to earn money. Even if it's down, even if it's up, it will continue to earn money. And one of the biggest rewards of dollar cost averaging is knowing that when you look back 30 years from today, or whenever you actually want to use the money that you invest, that you didn't spend a single second stressing about whether or not you can make $1 or $2 extra on a trade, because in the grand scheme of things, that $1 or $2 doesn't really matter. If you're trying to squeeze out an extra $5 on a trade here, extra $10 on a trade there, the stress of doing that is not worth it if you have a long investment timeline. And by long investment timeline, I don't mean 1 year, I don't mean 2 years, but as I'm going to talk about later in this video, I'm talking about investment timelines of 10 plus years, and knowing that the likelihood of the stock market not being positive in 5 to 10 years is extremely low. But now let's take a live look at my portfolio and my portfolio contributions so you can see how dollar cost averaging works in real life. So as we pull up my Fidelity portfolio, that's currently valued at a little under $32,000. If we take a look at the contributions I've been making over this past year, we can see a fairly consistent story. And at the beginning of the year, when I was contributing money to my Roth IRA, as we look at all of the things I bought, we can see that I only bought 3 index funds every single month. Every time I had extra money to invest, it all went towards 3 index funds. No matter matter what the price was, no matter how much money I had, I always dollar cost average in 3 index funds. And what those index funds were FSK8X, which is a Fidelity Total Stock Market Index Fund, FSRNX, which is a Fidelity Real Estate Index Fund, and FTIHX, which is a Fidelity International Market Index Fund. And what I wanted to show that to you for was to show you a real life example of buying no matter what the price is. When I went to put extra money into the portfolio, it didn't matter if the stock was up, if the stock was down, because I knew I needed money to be invested in order for it to start working for me as soon as possible. In the grand scheme of things, if I try to time the market today, or if I don't let my money work for me as soon as possible, I will be restricting the amount that compound interest can work in my favor. Because in 20 to 30 years, when I actually get ready to live on this money, it wouldn't matter if I bought on February 22nd or June 1st, because as long as I put as much money as I possibly could in my portfolio as soon as I could, that money will continue to trend up over time as the stock market continues to do year over year. And now let's talk about why I invest in index funds in my particular portfolio, and why I believe, in my personal unprofessional opinion, that index funds are the best way to go. So with the dollar cost averaging approach, the whole purpose of it is to take away the headaches from investing. It's to take away trying to know what to invest in, trying to know what to pick, and to just continue contributing money. So I believe that index funds are the peanut butter to the dollar cost average's jelly, meaning that they are a perfect match. The reason why I invest in index funds in my portfolio is because I would rather not try to sit around and decide what specific stocks I want to invest in. I don't want to be someone who analyzes financial spreadsheets. I don't want to be someone who reads income statements. And by investing in index funds, I should never have to do that, because what an index fund is a gift wrap of multiple companies, sometimes hundreds of companies in market sectors that you can buy for just one price. And most of the time, by investing in index funds, you can invest in the overall stock market. You can invest in thousands of companies all at once. And if one of those companies go out of business, you will have all of the other companies in that index funds propping it up so that your portfolio doesn't drag down with the one company that fails. And the reason why I say this pairs so well with dollar cost averaging is because it provides you with peace of mind as well. You don't have to worry that one or two companies are going to be out of business in 10 years because the index funds switch and swap out companies as they grow and leave in their market. If I was investing in the S&P 500 index fund and a company fell out of the S&P 500, I don't have to do any work to replace that company in my portfolio. The index fund I'm invested in will automatically replace that with another company that just has entered. So not only is this diversifying your portfolio and lowering the risk, but it's also automatically managing it so that you can sleep peacefully at night. However, the biggest thing to keep in mind, and probably the most important point of this entire video, is that in order for dollar cost averaging to work, you have to have a long investment timeline. You can't be trying to buy and sell in order to make a quick buck. So if you are making investment decisions to reach financial freedom, or to reach a point where you don't have to work a W-2 job anymore, and you know that point is going to be 5 to 10 years in the future, then by focusing on this long investment timeline, focusing on that someday in the future you actually need this money rather than today, you won't be as discouraged as the value of your portfolio falls a little bit from a day-to-day basis. In 2022 alone, most portfolios are down 15 to 25%, and that is just a part of the normal cycles of the market. As the market goes up by a bunch, it is natural that it will fall and correct itself before rising again. So right now, when most investors are scared, right now when most investors are pulling their money out of the market because they are scared to lose even more money, this will be the time where most millionaires are made. Looking back in 3 to 5 years, you may see this year as the best value of getting stocks that you know will perform well in the future. If we look in hindsight and look at 2008, when the stock market dropped by 40 to 50%, if you had put all of your life savings in the stock market in that time, it would have doubled or even tripled by now. So understanding how to be greedy when other investors are fearful will help you make a lot of money in the stock market, because you're going to be buying when other people are selling, and you're going to be making even more money when the market rebounds. But with all that being said, I really hope you found value in this video, and if you did find value in this video, then tap that like button for your boy, as well as hit that subscribe button if you want to see more content like this. If this video helped you understand how dollar cost averaging works and you want to get started on your investment journey today, then go down to the description where you can sign up to the public app, and if you sign up using my link, you will get a free stock as a gift from me to you. I don't know how long that offer is lasting, so go get your free stock now. However, I hope you enjoyed this video, and I'll see you in the next one, guys.